The market didn't break when things went wrong. It adjusted. That should worry you, because crashes are loud. Instability is quiet. And today's markets are very good at living with quiet instability. Right now, prices swing wildly. Debt is higher than ever. Governments intervene constantly. And yet, markets keep moving like this is normal. That's the story. Not why markets crash, but why they don't. Why instability stopped being a bug and became a feature. This matters right now because we're living in a strange moment. Interest rates rose faster than almost anyone expected. Banks failed, then were rescued overnight. Inflation spiked, then got renamed sticky. Volatility jumped, then got priced in. Each time, the system flinched, then carried on. No panic, no reset, just adaptation. To understand why, forget charts for a moment. Think behavior. Markets are not smart. They're habitual. They learn what survives. Every time instability hits and nothing fully collapses, the lesson is reinforced. This level of chaos is acceptable. That's how normalization starts. It didn't begin recently. Go back a bit. In the past, instability was punished. High inflation meant tight money. Asset bubbles popped and stayed popped. Bad bets actually failed. Pain lasted long enough to change behavior. But over time, something shifted. Central banks stepped in faster. Liquidity arrived sooner. Backstops got bigger. Each rescue made sense in isolation. Together, they changed expectations. Markets stopped asking, "Is this stable?" They started asking, "How unstable can this get?" before someone steps in. That's a very different game. Here's how the system works, step by step, without jargon. Step 1, leverage. Modern markets run on borrowed money. Not just a little, a lot. Leverage amplifies gains, but it also amplifies fragility. Small shocks matter more. Step 2, speed. Information moves instantly. So does capital. Fear doesn't have time to build slowly anymore. Spikes, then fades. Step 3, intervention memory. This is the key part people miss. Markets remember outcomes, not warnings. If instability happens and is contained, risk doesn't disappear. It gets repriced. Volatility becomes just another input. Like weather. A storm isn't a reason to leave the city. You bring an umbrella. That's what derivatives, hedging, and short-term trading really are. Umbrellas for instability. The uncomfortable part is the math underneath. When instability is expected, it doesn't vanish. It compounds. Risk builds quietly because everyone believes they can exit in time. But exits require buyers. And buyers disappear together. That's the hidden mechanism. Stability used to come from limits. Now it comes from confidence. And confidence is fragile. There's an irony here. The more markets adapt to instability, the more unstable the system beneath becomes. Because adaptation encourages more risk-taking. If the floor keeps getting reinforced, people build higher. Hype tells us markets are resilient, flexible, anti-fragile. Reality is less flattering. They're dependent on liquidity, dependent on credibility, dependent on the belief that tomorrow will be managed like yesterday. Zoom out and the risks get bigger. Normalization of instability changes how capital is allocated. Long-term investment gives way to short-term positioning. Price discovery gets distorted. Signals get noisy. The system doesn't collapse. It drifts. And drifting systems don't announce breaking points. They just cross them. Which leaves us with the uncomfortable question. If markets have learned to live with instability, what happens when instability demands something markets can't price, hedge, or postpone? Not a crash, not a panic, just a problem no one trained for. That question is still unanswered.